Hello, my name is Tristan Sena, and today I will be giving a presentation on the digital frontier of accounting. So to start with an overview, the goal of this presentation is to evaluate the integration of data organization or the use of big data, predictive analytics, and artificial intelligence within various fields of the accounting profession. Specifically, we will dive into the application of these technologies to determine their impact on the industry, along with future implications as accounting firms look to move away from manual historical reporting methods. For each accounting discipline, you will notice how data cleaning and organization is the basis for essential innovation here, and predictive analytics, along with artificial intelligence, build off this system and take these professionals into the modern era of accounting. On this graphic, you can see how, again, data cleaning and organization, predictive analytics and statistics, and artificial intelligence all feed into these new innovations that we are seeing in the accounting profession. And there on the left is the four main branches of the accounting profession that we are focusing on today. First, we will take a look at the impacts of these technologies within auditing and assurance services. Data cleaning and organization can describe the beneficial use of big data. Thus, in the auditing profession, we are seeing a large shift towards large data set usage, and data-driven models. These models are allowing audit firms to commence in continuous audit procedures and real-time risk monitoring. This is a large shift compared to the traditional year-end audits that we are used to seeing. So essentially, rather than having to wait till a year in to complete an audit, a lot of these assurance procedures can be done as the year goes on, which can be greatly beneficial for audit firms and their clients. Um, as these big data usage models become more advanced, real-time data feeds will allow continuous audit functions to constantly monitor transactions and immediately flag anomalies within data sets. While we will cover AI integration here shortly, data cleaning and organization sets the groundwork that allows AI and other predictive analytic models to be implemented within an auditing firm's systems. Again, the main focus here going forward is that auditing firms are looking to move away from year-end audits and move towards more real-time auditing with their clients. And well-structured data through data organization allows them to continually do this while offering the most accurate assurance services possible. Now, if we look at predictive analytics specifically within auditing, we see that it's a huge an innovative step for audit firms around the world. Specifically, these technologies allow firms to make use of their historical data to help predict anomalies and potential fraud detection. Furthermore, predictive analytics tools ensure that audit firms are providing the most accurate risk assessments possible, which in turn lead to more precise audit judgments and decision makings. So again, we're already seeing how predictive analytics within auditing is allowing for auditors to make more precise opinions on these audits rather than having to essentially wait till they get this data and then quickly scan through it. They can kind of do it in real time now. Going forward, more advanced predictive analytics systems will help identify anomalies and other unusual patterns before they even become misstatements. Furthermore, more advanced systems can forecast high-risk transactions, which allow for a tighter audit scope. These systems will also allow for auditors to analyze entire populations of data rather than just a sample, specifically through automated processes that give instant evaluations and alerts on that data. Overall, this results in more reliable expectations and audit opinions. The big thing here is I think that the ability to scan entire populations of data rather than just a sample is one going to give um, the auditing firm a lot better idea of the controls that are going on within this firm or whatever client they may have. But again, if they want to focus on really specific high risk transaction areas, they can really have a tighter audit scope to really see what's going on behind the scenes. When it comes to artificial intelligence being implemented within auditing, machine learning tools and natural language processing tools lead the way here. These AI-enabled tools can result in an improved data accuracy, compliance monitoring, and automated transaction testing. This essentially reduces the opportunity for human error through automation and increases overall operational efficiency. As these AI-enabled tools become further embedded within auditing workflows, aspects like machine learning will allow tools to essentially learn from themselves from the historical data that's provided and through the transactions they've tested in the past. Thus, we will likely see a shift towards complete automation of manual work in the auditing profession and a shift in the overall roles of auditors around the world. Rather than being simply used to test transactions and monitoring, auditors will step into a more analytical role where making decisions is critical to the overall future compliance of their clients. So I predict that auditors will essentially be more strategic business partners rather than just a year-end necessity to test transactions that they've gathered throughout the year. Okay, now we will look at how these technologies are specifically impacting tax accounting. Data organization and cleaning is again the foundation of tax compliance. Centralized databases with clean data and structured workflows heavily reduce the reliance on spreadsheets and fragmented data sets. Not to mention, this also reduces control issues and provides better audit trails throughout workflows. Data organization allows for financial systems and tax systems to be integrated together, which have the ability to share data among each other. So going forward, data organization will continue to play a role in further reducing errors caused by poorly structured data sets and, of course, human error. Furthermore, this will provide tax accounting firms to streamline workflows and significantly reduce bottlenecks. Most importantly, this type of technology helps ensure that data is reliable, accessible, and easy to use at all times throughout the tax accounting workflow. And again, that fact among itself is essential to maintaining tax compliance. One huge impact that specifically predictive analytics can have in tax accounting is the ability to predict tax liability. Through the use of structured historical data and narrative disclosures, this technology can anticipate effective tax rates and forecast potential financial outcomes. This is greatly beneficial when it comes to tax planning, as firms can generate strategies to mitigate tax liability through a comparison of predicted financial outcomes and predictive effective tax rates before the filing process even begins. In the future, predictive analytic technology is expected to predict effective tax rates with higher precision. In addition, as financial data systems and tax systems continue to become more embedded with one another, automation of tax planning and filing becomes prevalent within these tax firms. This will also aid in early detection of potential tax exposure and enable firms to complete scenario analysis through scenario models for even more precise tax planning results. So they can essentially use what if analysis through these models to determine, okay, if you were to have this revenue and these expenses, this is what your tax liability would look like. And they can do that in several different ways and compare and contrast. Artificial intelligence has revolutionized tax law research. This is because AI-enabled tools are able to analyze large amounts of statutes, regulations, and case law within seconds. This has eliminated the need for countless hours of tax research. In addition, these AI tools can generate suggestions and answers to complex tax questions that are rooted in real tax research. Some future impacts here are quite clear. AI-enabled tools will be able to instantly retrieve relevant IRC provisions, regulations, and rulings. These tools can also generate summarized legal interpretations that can help guide firms and their clients on next steps in the filing process. In addition, these AI tools are evolving to embed into knowledge management systems, which we see a lot in tax firms. And these can help ensure tax workflows automate towards proper tax compliance with all filings. So if it's embedded in the knowledge management system, it's going to ensure that whatever filing you're looking to make, that it's going to be compliant, or else it's going to get kicked back. Now, I will say it should be stated that AI tools should not completely replace professional legal advice, but only be used as additional supplementary information. However, the time it saves is incredibly useful. Now we'll look at managerial accounting and how these technologies are implemented there. In general, like other fields of accounting, data organization and cleaning allows for deep data integration across departments. This is essential to ensuring that data can be properly structured with standardized classifications, along with report generation. This results in a cost accounting system that produces reliable and consistent data and reports, as departments will no longer use their own classification for cost categories. For example, here at Eastern, physical plant may have a different system of having cost classifications than the business office. And through the use of big data organization and models, those things will all be consolidated together. As data organization systems continue to advance, cost systems will become more precise to provide an even clearer picture of a firm's resource allocation. As these systems become further ingrained in a firm's workflow, they will continue to mitigate opportunities for human error in cost allocation and reporting. This will also provide opportunities to complete cost comparisons across departments and track costs in real time. Real-time cost tracking, or real-time tracking of cost drivers rather, is especially significant here, as it can allow firms to make cost adjustments in real time rather than waiting for the next reporting period. So if they see a cost driver shooting up really quickly, they don't have to wait till a reporting period to make an adjustment. In a nutshell, predictive analytics has been used to aid managerial accountants in generating more accurate budget forecast. This enables managerial accountants to identify financial risk before they occur, as they rely on data-driven planning rather than historically based budget methods. These statistical models also allow for dynamic and continuously updated budgets and forecast. Going forward, these models will also allow for what-if simulations that allows accountants to anticipate future revenues, cost, and risk. Knowledge of these aspects for cost accounting will certainly feed into a firm's overall strategic plan going forward. The ability to clearly predict potential trends and cost drivers also ensures accountants can forecast as accurately as possible, while also optimizing their current resource allocation. Managerial accounting receives multiple benefits from the implementation of AI-powered tools. AI works in unison with predictive models and data organization to provide real-time financial reporting, which supports faster decision-making. It also significantly increases data accuracy and reduces opportunities for human error throughout operations. Finally, AI embedded tools also allow for automation of routine accounting and cost tracking tasks, which results in a vast increase of operational efficiency. Going forward, we predict that AI tools are highly likely to further refine that automation process and reduce overall labor cost. AI will also continue to increase processing cycles to ensure continuously updated financial and operational data, which allows for performance and cost evaluations in real time. AI-empowered tools will improve its ability to quickly and accurately analyze large data sets, searching for inefficiencies to provide deeper insights into cost and performance. These insights have the ability to lead to decisions to help operations run more effectively and efficiently throughout the year. Overall, AI is transforming the role of managerial accountants from cost transaction keepers to strategic, data-driven decision makers that can aid in guiding a firm in the right direction. Lastly, we will look at financial accounting and the impacts of these technologies here. Data cleaning and organization functions very similarly in financial accounting as it does in other fields of accounting. It allows for continuous processing of transaction data while also allowing firms to centralize data platforms and automating data pipelines. As a result, real-time data feeds are constantly running through the system, allowing for real-time analysis of reporting information. As mentioned from other fields of accounting, data organization can greatly reduce human error, improve report accuracy, and reduce report generation time. These real-time data feeds specifically aid financial accountants as they are constantly checking transactions for anomalies and other errors. This means that transactions that contain an error that will raise a red flag long before they are entered into any type of financial report. Again, this would vastly reduce misstatements within these reports overall. In addition, real-time data feeds are building these reports each day rather than at the end of a reporting period. This allows for financial accountants to gain insights in real time and make more informed decisions based on the available data. So reports are being made each and every day with the data that's entered into the system rather than at the end of a reporting period, which again, lots of advantages there as they can use it in real time. Predictive analytics models allow financial accountants to analyze historical data, patterns, and payment behaviors much more closely. Thus, as predictive models are integrated with existing ERP accounting systems, financial accountants are able to produce much more accurate forecasts, especially when it comes to predicting cash flows. Having accurate forecasts of cash flows, like when to expect cash flow shortages or surpluses, can be essential when financial planning and managing risk. These predictive models are continuously being refined to ensure more accurate forecasts and easy to understand cash flow assumptions. Specifically, the systems are beginning to understand the complexities behind receivables and payables and the timing behind that, which being financial accountants is one step closer to real-time cash flow forecasting, which is very difficult to achieve. If firms are able to achieve real-time cash flow forecasts, this will significantly benefit their firm's ability to monitor their liquidity position on a dynamic basis, again, rather than at the end of a reporting period. As a result, firms may achieve better working capital management throughout the year, which makes it much easier and quicker to make capital investment decisions within a short notice. The most prominent use of artificial intelligence in financial accounting is to help automate financial reporting. AI tools have the ability to compile data, reconcile that data, and prepare financial statements without any manual intervention whatsoever. This can result in fast, reliable, and consistent financial reports that can be generated within a moment's notice. As we go forward, these AI tools and reporting can impact financial accounting in several different ways. End-to-end automation will allow for automatic detection of inconsistencies and errors in financial reports. It allows for real-time financial reports, which can be very beneficial when working with lenders, shareholders, and any other stakeholder of a firm. The vast reduction in report generation time means financial accountants can be more operationally efficient while also giving them the ability to provide more analysis on the financial statements rather than spending all of their time simply preparing them. In addition, reporting quality and compliance with applicable regulations will also become more consistent as well. Again, the integration of AI tools in financial reporting has the ability to completely shift the role of financial accountants from simply preparing reports to more strategic business partners that provide valuable insights to a firm based on a more focused analysis of the reports they're providing. Thank you. That was my presentation on the digital frontier of accounting, and I look forward to see what developments come into the profession next. Thank you and have a blessed day.